Okay. First of all, can everyone see my screen share there where I've got the briefing notice up? Okay. Is it large enough to see? Okay. All right. That's always the first step. Mayor Hoffman, would you like to take it from here, or how? I've never been a part of one of these briefings before. Do you want me to pretty much go through this thing? There's not much to this one. We're doing a briefing instead of a meeting this time, and our plan is to just approve anything that needs to be approved at the next meeting in May, which will be our large meeting with the budget and actual report and financial statements, all of that. And we'll just start the meeting off by approving the minutes from the previous meeting, and then any actions that we would have taken during this meeting.
Yeah, I don't think we need to do any formal opening, closing, or anything like that. So I would say just go ahead with the agenda. But I did want to add that we did have a resignation from the General Employees Board, and I'm working with the city manager to make sure we have an appointment, a new appointment before the May meeting, since that's a pretty big deal meeting. So we'll work on that.
Thank you. All right, and with that, we'll go to Brendan for the investments consultants report, and then I'll come in after that. Do we have Greg in here? I just wanted to see if he was in here. Well, we'll deal with that when we come to it.
Dustin, Greg is an attendee. Do you want me to move him over?
We'll just wait until the end of Brendan's presentation, and then then we'll promote him up.
Okay.
Well, good afternoon, everyone. Dustin, is it easiest for you to drive through the report, or would you like me to share my screen and go through it?
Whatever you feel is best. I think I've already got it on here, so might as well just.
Great. Yeah, so there's not too many pages. This is the kind of the summary version. So we'll start here with the firm letter. This is something that you've seen from us in the past. The first of the year, we always put together a firm letter from our CEO, Mike Welker. I'm not going to read you the letter, but I did want to just highlight a few things. First and foremost is a thank you. Without clients like you, we don't have a firm at all to serve. So again, just want to mention our appreciation. 2020 was obviously a difficult year for everyone, but we remain committed to our commitment to you to reinvest 100% of the profits of the firm back into the business. So despite the challenges, we were able to continue on that track where we invested in personnel. So the team is now up to 91 team members through the end of the year. And then additionally, continued technology investments, compliance, marketing, research areas. Those are the primary areas that we've been focused on that reinvestment. And that is something likely to continue for at least the next few years. Those are kind of the most capital intense parts of the business, and we continue to do additional reinvestment in that area. And then the last item that's highlighted in the letter is the addition of 2 new partners, Jacob Peacock and Dan Osika. As you might recall, we are a 100% employee-owned partnership, but we are in a program where that ownership is being distributed amongst a greater number of the employees of the firm. So we did want to just update you that the 2 members had been added to the partnership group. As you might recall, a couple of years ago, Dan Johnson was added to that partnership group. And again, that's something you'll likely see continue in future updates like this. So I'll kind of pause and take any questions if there might be any related to the letter. Otherwise, I can kind of go into the report itself. Okay, well, hearing none, I'll jump into the first or the next page, which is what we call the market environment. And the short version is the market through the end of the year was fantastic. The last quarter, we saw international markets up about 16%. We saw the S&P 500 up about 12%, which just continued that recovery from what was that awful quarter back in the first part of the year. So the theme really remained the same. You had the Fed continuing to support the markets and indicating that they would do more if they had to. We had the uncertainty of the election get behind us in the quarter, and then continued optimism as we had, positive vaccine news, and then obviously the vaccine rollout starting. So I think what you're seeing with the underpinning of the Fed support, and again, the market trying to look forward related to the COVID vaccines, that maybe things will return to normal, maybe a little bit faster. And that's a big part of why we saw the markets continue to recover the way they had. So ultimately, in the bottom right-hand corner, you can see the last 12 months wound up being very positive, although again, sort of lost in that is the horrific first quarter where equities were down at one point about 33 to 34%. But again, certainly a nice recovery. And as you'll see in a few pages, your plan recovered quite nicely in lockstep with the markets. The next page just highlights a quick breakdown of the difference between value and growth equity. For years, we've been talking about growth doing better than value. And just an interesting shift here in the quarter. If you look in the upper right hand part of the page, you can see that the blue bars did better than the red bars. Value did better than growth by a good margin in this quarter. And that's, one of the few times that we've seen that as of late. But despite the good quarter for value, when you look down in the bottom right-hand corner, you can see that over the course of the year, growth still did significantly better than value. Value was positive, single digits, but depending on which benchmark you're looking at, the growth benchmark was up somewhere around 38%. So a substantial level of outperformance. As we move to the next page, just one quick highlight on fixed income in terms of interest rates. For the prior few quarters, we had seen very little change in interest rates, but what you'll notice in the bottom right-hand corner is that green line is getting a little higher on that far right-hand side of that graph. So the rates on the shorter end of the curve haven't changed a whole lot, but they've started to rise on the high end or on the long end of the curve. So those longer interest rates are going up, which is generally a positive sign related to economic growth. I mean, that's the bond market saying they're expecting growth in the future to be better than they did, 3 months ago or 6 months ago. But the bad news is that can obviously be a headwind for your fixed income portfolio because rising interest rates cause decline in prices of those fixed income securities. Again, those changes are relatively muted, but did want to point that out. Moving to the next page, just tracking the asset value of the portfolio relative to kind of that assumed rate line as well as your cash flows. And you can see this graph is kind of looking better and better as of the last few quarters. So you can see the increase in assets up to $111 million, well in excess now of that $92 million line that represents the assumed rate of return. And then, of course, the bottom line represents, or those blue bars at the bottom, represent that net cash flow. So you're actually negative cash flow by a fairly significant margin, yet we're able to continue to grow the assets of the plan at a faster rate than certainly the net outflows as well as the assumed rate of return. So that is a very positive looking chart there. Moving on to the next page. Just a quick snapshot of the asset allocation, the breakdown by manager. And Dustin, if we could actually just go to the next page, which summarizes the total breakdown by asset class relative to target. What you'll notice is we're about 4.7% overweight to domestic equity, about 1.9% overweight to international equity, and underweight a comparable amount to both domestic as well as global fixed income. And that's really just a function of performance. In the last quarter, your equity portfolio is up close to $10 million, where the fixed income portfolio was close to flat. And in a period like that, obviously the equities are growing to be an outsized portion of the fund, which is obviously great news. It means your portfolio did well, but it does create a little bit of an imbalance that I'll get back to a little bit later. But when it comes to actual performance, we get to I believe it's the next page. as I referenced, the fund did just fantastic. So for the quarter, up 10.36%, beating the benchmark of 9.25, and you placed in the 42nd percentile among the public fund peer group. For the year, the last 12 months, again, despite that horrific market that we had back in February and March, you were still able to return in excess of 16% for the year 2020, and you placed in the 17th percentile among the public fund peer group. And again, if you go out to the longer periods, whether it be 3 or 5 year, look at those numbers in excess of 10%. So from an actuarial perspective, just returning exactly what you need for very positive results. I'll try to be brief as we look at the individual managers. You've got Vanguard Total Stock, which did exactly what it's supposed to. Wells Cap had a very good quarter, up 14% versus its benchmark of 11. And for the year, 40.7% versus its benchmark of 38. So obviously fantastic absolute performance, up over 40%, but even a little bit better than the benchmark. JP Morgan Equity Income, that is our large cap value fund, did about 13%, but that was behind its benchmark of 16%. And then for the year, 3.6 versus about 2.8. So again, good relative to the benchmark, but certainly very muted results relative to Wells and the growth portfolio. The last piece on this page is the Eaton Vance Atlanta Capital. A little disappointing for the quarter, up 21.3. I mean, it's hard to be disappointed with a return above of 21%, but that was behind the benchmark, which was up 27. And they actually were behind a little bit for the year, 11.3 versus 19. But as you can see over the longer periods, that portfolio has done very, very well over time. Just obviously had a difficult quarter and difficult year, but we don't view that as a long-term problem, just a kind of a difficult quarter in what was a very volatile period. As we move on to the next page, you get into our international portfolio, and you had very good results here, in particular for the year. So Euro-Pacific was up about 20% versus that benchmark of 17, and for the year, 25.5 versus 11. So phenomenal relative performance. And then WCM with your focused international growth was up about 17%, roughly in line with the benchmark, but for the year it was up 32 versus that benchmark of also up 11%. So again, both of your international managers did extraordinarily well over the year 2020. That concludes all of our equity portfolio. So now we get into fixed income and our other assets. So you've got Sawgrass, who I understand is on the line and will be speaking with you shortly. But they had a good quarter, up 43 basis points, beating the benchmark, and for the year, 8.5% versus about 7.2. So a very nice, both absolute as well as relative quarter. But what I would say is, 12 months ago, we weren't really hoping to get 8% out of fixed income. The only way that was going to happen is if interest rates fell pretty dramatically, which is ultimately what happened. Usually when there's a fall like that in interest rates, it spells trouble for equity investments and other things. But fortunately, we were able to kind of weather that storm in the first part of the year. So we got those good fixed income results, and we were able to combine them with good equity results by the end of the year. The next portfolio is your Pimco Diversified Income. Again, this is what replaced Templeton Global Bond that had been underperforming for a while. And it's off to a good start for the quarter, 4.17 versus about 3.5%. So that's obviously a very, very nice return there. And then we've got our JP Morgan real estate portfolio, 1.9 versus about 1.3 for the benchmark. And for the year, roughly in line at about 1.4%. We've talked previously about some of the valuation issues with real estate. They're working through that kind of part of the valuation cycle. So returns in the short run are likely to be muted here for the next few quarters. But then as additional transaction activity takes place and additional market information and recovery, hopefully we'll see that pick back up in the latter part of the year. So that really concludes everything that I wanted to highlight in terms of the portfolio and an overall return. I'll kind of pause there, see if there are any questions, before I just kind of highlight one other page that I have included in the book. Okay, well, hearing none, Dustin, this is on the fee page, just as a reminder of all of the fees that we're paying for each one of these portfolio managers, and ultimately that entire portfolio is being run at less than 0.5%, which is obviously very competitive. But the next page is the item that I referred to a minute ago, and hopefully this doesn't give you flashbacks to your high school chemistry class. But I think you've seen this from us before. It is just the calendar year returns of most of the major asset classes, and they're ranked by from best performing on top to the worst performing on the bottom. And really, the short version of this particular chart is this is why we diversify the fund. In any year, we really have no idea what's going to be the best performer, the worst performer, or somewhere in the middle. And that's why we build a portfolio that has a reasonable blend of different asset classes, large, small, growth, value, international, to try to optimize the return possibility of the fund while minimizing the relative amount of risk. So again, most folks like to see this graph, and since we had it updated through the end of the year, I just wanted to share it with you. With that, I will. Actually, Dustin, if we could go back to that, the allocation page, which I think was page number 6, if memory serves. Sorry, one more, so it would be 7. Sorry, the other way. So one thing I did want to mention to the group is obviously you can see our overweight to equity given the recent market performance. And I ran the plan assets as of this morning, and this actual overweight has gotten worse, so to speak. We've continued to have good results in January and the early part of February. So the portfolio is actually up to $115.1 million, up roughly another $4 million from where we were at the end of the year. But that has further increased the equity overweight. So obviously not having an official meeting, I guess I'll sort of pose the question: are we able to take some action related to rebalancing, or at least follow the policy? But what I would suggest if this was a full meeting would be to talk about doing a rebalance to bring that equity back down within the normal ranges of the policy.
Well, we didn't really talk about this beforehand, so I wasn't really thinking about doing anything this meeting. I wouldn't even had it on the agenda had it been a full meeting. Okay.
Well, I get, we did have some cash flow from the fund, just the regular benefit payments that is going to reduce that amount. But I guess that's something we'll put on the agenda for next time, assuming that it's still.
Yeah, I did think that we had a couple of big backdrop payments coming out. I know we had, almost 400,000 in big backdrop payments coming out in January, and I thought that would be enough to rebalance, just to bring down some of that equities combined with our normal drawdown. So, I'm not. Maybe that wasn't enough with the type of performance that we've seen here, especially even since January 1st. So.
Right. Yeah. That drawdown of the 600,000 that was needed is roughly 0.5%, but the portfolio is up over 3% so far in the current quarter. So, like you said, we've grown kind of above and beyond even what that cash flow need was.
Okay.
Well, we don't need to take any more time on this. We can discuss that on the side, and again maybe put that as an agenda item next time.
I guess it would depend on performance in the next few weeks. I mean, if we need to have a special meeting before the May meeting, then we can do that as well. But I'll just get back with you and we'll monitor and see how that goes.
Very good. And then the only other item that's sort of related to our reporting would be the news item out of Sawgrass. So I understand that Greg is on the line. So if you guys feel it's appropriate, maybe it'd be best to bring him in at this point to kind of explain some of the personnel turnover there and discuss that with the group.
He should be appearing here in just a minute.
Okay, I'm sure you can hear me if you can't see me. Oh, there I am.
Yeah.
Well, good afternoon. I know most of the people that I see on the screen, although Dennis Pavlovsky was kidnapped by someone with a big beard. It's good to see you. But for those who don't know me, my name is Greg Gosh. I'm Client Services Director for Sawgrass Asset Management. I've been with this now. It's my 14th year, and I used to attend all your meetings. I used to go to every one of your meetings, and finally someone said to me, "Why you go to all our meetings? You only present once a year or every once in a while." So now we come when you ask us to, and today I'd rather be in person with everybody, but obviously we're all in separate locations due to the virus, and hopefully this will be in 6 months or 3 months. We'll be able to sit down and meet again together. The reason I wanted to be on this this call or meeting is in January, Chris Greco, partner with the firm, our number one salesperson, left the firm to become president and CEO of another investment firm, a hedge fund, and a large cap core and mutual fund company out of Louisville, Kentucky. This was a mentor that Chris had worked with out of college that was one of the principal investors in this firm. They've been around for a while, but they want to expand and grow into other places where they aren't currently. They wanted him so bad, they're moving their operational headquarters to Ponte Vedra Beach and opening an office in Sawgrass for him. And two of the folks that also left with him, Anthony Brooks, who was a equity analyst for us, and Chris Herb, who was a marketing analyst on my side of the building, along with Chris Greco. So Chris is a great friend of mine, always will be. He's going to do fantastic. I hate to see him leave. We all do. And, I've got big shoes to partially fill, but no one who left the firm had any operational duties at all with your portfolio at all. Chris Herb may have produced a report or two that was sent to ANCO that may have contained some of your data. Anthony Brooks is on the equity side, and of course Chris didn't really deal with you guys even on the client service area. So I wanted to let you know, because these were important people to our firm. We hated losing them. But the firm is still on solid ground. We're still at 3.28 billion in assets under management, and the guys running the show on the investment side are still with us, and most importantly, I'm still with us. So you still get to deal with me, even though it's been a while. So that was tongue in cheek. I wasn't trying to be cocky, just for those who weren't listening. But I'm here to answer any questions, but I also wanted to be transparent. And you know, this whole year I've been on the phone every day explaining the same story to people. So it's good to get everybody at once. I know we already had a call with ANCO a month ago, but are there any questions or comments? Okay. Well, as soon as this thing's over and you guys are comfortable, let's all grab dinner. We don't have FPPTAs anymore. We don't have conferences. It's frustrating, especially for what I do. So thank you for your time and your ears on this. And we appreciate your business and your trust and confidence. We are actually in your zip code and your taxing authority of Jacksonville Beach, and we really appreciate the relationship. And look forward to continuing that. And thank you.
Thank you, Greg. Can everyone hear me? I know my internet connection is kind of fading here. The video and everybody keeps freezing. So As long as you can hear me, I think that's good. We'll just scroll on down here to the pension administrators report. Everything just reloaded there on our video. I'll just start off up here at the top with the general employees rundown. 243 active members, 202 receiving eligible withdrawal benefits, and then 67 active members for the police, 43 receiving eligible benefits, and then firefighters, so 25 active members with exactly 25 eligible to receive benefits. Pension plan has distributed 138,000 already this quarter. And I'll scroll down and kind of show you how that looks. It actually all came from the general employees here, with most of it coming from 2 employees and the other being small amounts. Those employees being one Beaches Energy and one Public Works employee that I think one of them was even vested, but still so young that they went ahead and pulled their funds out because they wouldn't have received them until they were 62. And I think they were around 30 something years old. So it would have been a while. So always got to make that strategic decision there when you're pulling your funds out that many years in advance. Let me come back down here. You'll see there's actually no change over the quarter for the police or the firefighters as far as active participants, vested, non-vested, any of that. So pretty uneventful there, but general employees did have a few changes, but nothing substantial. Coming back up, we do have some upcoming retirements, or in Catherine's situation, she is already departed. We do. So I'll start with Richard Langston, and we'll approve these at the next meeting or the next meeting that we have. There's a line crew leader, Public Works, doing the backdrop, has met his agent service requirements. And I know this says 30 years of service, but it's actually 33 that he is backdropping for 3 of it. So that's why the effective date is 2018. So we have Annette Hayes here as well, who separated some time ago, probably, I believe 4 years ago. Yeah, right there. That was when I first started working here. And she was in the utility billing department for 25 years and just deferred her retirement until she became age eligible, which starts next month. And then Catherine Martin, permit specialist, been with the city 15 years, has already met her age requirement and will now be, has already separated a couple weeks ago or last week, and will start receiving her pension for February. Conferences. So we've not really had the conferences, just like Greg had said, and because of that, Eddie and I pretty much have to attend this virtual FPPTA conference that is going to be held in May, or else we lose our CPPT certification. So we have to attend that. Now, the rest of you have the option to attend either this one or the one in the fall. We don't know yet if the one in the fall is going to be an in-person meeting or if it's going to be virtual as well. So that would be Nick, Debbie, Ed, David, and Jason. So anybody else who's interested and would like to learn about it, anybody's interested in these conferences, I've just wanted to pass along through my contact with FPPTA what our current status is for everyone, and make sure that none of us fall too far behind here. And once we get a new member on from the council, if they're interested in this, they are having a one-day virtual conference for new trustees. That may be a good rundown on pension plans. Next scheduled meeting is Tuesday, May 11th. I have here 3 p.m. That's incorrect. It's 2 p.m. because that's our large meeting. And we always start that an hour earlier so that we can make sure we try and get everybody out of there by 4. But we'll see how that goes coming up. We'll get everything figured out. And then, like I said before, I'll circle back with Brendan Mebrica on that balancing as well. Are there any questions for me or anything that's going on? Okay, well, I think that's all I have if there aren't any questions. I can't tell if everybody's just froze or not. So, all right, with that, I think we'll end this briefing, and I'll be in contact with any updates.
So Dustin, you can hear us?
Oh, now I can.
Oh, well,
Now I can.
just checking.
Now I can hear you, Marvin. Did you have a question?
No, I just wonder, is this an official meeting?
This is a briefing. We did a briefing because we thought it might be a challenge with everything going on to still meet in person. I know some people don't want to meet in a room, with 15 or so people at this point in time. And really there wasn't anything extremely pressing that we needed to, move monies around or anything this meeting. So the idea was to do a briefing and then just pass the minutes and approve the investment report at the May meeting.
Okay, we won't have to have a special meeting regarding that rebalancing, will we?
Well, like I said, I'll follow back up with Brendan on that. If we do, it probably won't be everybody all at once. It may be, try and get at least 3 members from each board to come in at different times whenever it works. I'll coordinate with those people if that's the road we go down to get some reallocation done. But like I said, I'll follow back up with Brendan to see, and I'll be in contact.
All right.
Okay. Thank you all.
Have a good day.